We see a private jet on the tarmac at sunset, or a billionaire stepping out of a penthouse, and we automatically make a grand assumption. We assume extreme financial wealth is the natural byproduct of brilliant strategy, hard work, and an unmatched understanding of the markets. But for 10 of the most revered figures in financial history, their billions were entirely fraudulent. The jets, mansions, and magazine covers were paid for by everyday retail investors and pensioners. These men did not walk into banks with ski masks and shotguns. They recognized that modern wealth isn't held in physical vaults. They scanned the structural architecture of the global market system, found the weak points, and bypassed the vault entirely. Every single one of these 10 scammers relied on one of 3 specific mechanical exploits to siphon off billions of dollars without setting off the alarms. To understand how the global financial market is actually manipulated, you have to look past the personalities and break down these 3 exact flaws. The first flaw relies on information asymmetry. A fair market requires every investor to have access to the exact same corporate data at the exact same time. If one group receives the data early, the scale immediately breaks in their favor. In the 1980s, Ivan Boesky appeared to have a psychic ability to predict corporate mergers. He didn't. He systematically paid corporate insiders to hand him non-public details before the press releases went out to the rest of the world. Decades later, hedge fund manager Raj Rajaratnam scaled this flaw into an empire. He built a vast human network of corporate spies, consultants, and executives who leaked him highly confidential tips ahead of official earnings reports. These traders were never analyzing trends or predicting what the market would do. They simply bought tomorrow's newspaper today and traded on the certainties. The second exploit is market manipulation. Scammers inject fake buy orders to simulate massive demand. In a pump and dump, they hype worthless stocks to trick investors, then cash out at the peak, causing the price to collapse instantly. Jordan Belfort mastered the psychological pressure required to make this work. Using an army of brokers, he relentlessly cold-called strangers and pressured them into buying the hype, ultimately stealing $200 million. In India, operators like Harshad Mehta and Ketan Parekh escalated this tactic. Using forged bank receipts to access capital and circular trading, buying and selling shares among their own associates to fake the volume, they drove the Indian market up by thousands of %. While Belfort and Mehta manipulated public shares, others manipulated the internal accounting of the institutions themselves. Operating out of Singapore, a trader named Nick Leeson made massive, unauthorized bets with Barings Bank's capital. To keep the scheme alive, he hid his mounting losses inside a secret error account labeled 88888. Those losses quietly swelled to $1.3 billion, bankrupting a 233-year-old bank. A manipulated market relies entirely on maintaining a fake reality. Eventually, the sheer weight of the actual numbers crushes the illusion. The ultimate exploit bypasses trading entirely, the Ponzi scheme. A funnel reroutes incoming capital directly into outgoing payments to settle old debts. A pristine chart of steady returns hides the chaotic flow, keeping investors unaware their money is already gone. Martin Shkreli utilized this exact funnel. While gaining infamy for hiking the price of a life-saving drug, he was secretly running a Ponzi-like scheme at his hedge fund, illegally moving assets from his public pharmaceutical company to cover private trading debts. Alan Stanford and Sam Bankman-Fried scaled this to a global level. Bankman-Fried projected the image of a harmless crypto visionary while secretly funneling $32 billion in FTX customer deposits to his private firm, Alameda Research, covering up massive gambling losses. Yet the apex predator of this category didn't wear cargo shorts. Bernie Madoff was a former chairman of the Nasdaq, relying on an impeccable, decades-long reputation to bypass all standard scrutiny. For nearly 30 years, Madoff ran a $64.8 billion ghost story. He executed 0 trades. He simply printed account statements on outdated 1980s computers to show fabricated, steady gains, using incoming cash to pay anyone who asked to withdraw. The absolute largest financial crimes do not manipulate the stock market. They bypass the market completely by manipulating pure human trust. When these illusions finally break, the resulting damage is absolute. Pensions evaporate, local markets shatter, and the operators are handed decades-long sentences in federal prison. Every single one of these financial crimes relies on the greater fool theory. It is the psychological flaw of assuming that no matter what you buy into, there will always be someone else further down the line willing to believe the lie and buy it from you. The global financial system cannot function without an inherent baseline of mutual trust between banks, brokers, and the public. That necessary trust is exactly what leaves the system permanently vulnerable. The most dangerous weapon in modern finance isn't a complex algorithm or an offshore shell company. It's a charming smile and a tailored suit. As long as human greed exists, the architecture of the market will be exploited. In finance, if a deal looks too good to be true, it always is.